Tell someone everything is going to be fine, and you sound like a salesman pitching a timeshare. But tell them they are in terrible danger, and you instantly sound like a wise friend trying to protect them. If an analyst promises a stock will surge tenfold over the next year, most of us will write them off as a scammer. If someone warns that same stock is an accounting fraud about to collapse to zero, we clear our calendars to listen to every word. We saw this play out in real time at the end of 2008. The global financial system was on day-to-day life support. Unemployment was surging, and markets were in absolute freefall. Right as the panic peaked, the Wall Street Journal ran a front-page article featuring the predictions of a Russian professor named Igor Panarin. He confidently forecasted that the United States was about to break into 6 separate pieces, with Alaska reverting to Russia and California falling under Chinese control. That apocalyptic vision was printed in the most prestigious financial paper in the world. Compare that reception to how the world reacted to Wilbur and Orville Wright. They achieved human flight. They solved an engineering puzzle that had defied humanity for centuries, and for years, almost no one cared. Newspapers refused to send reporters, assuming the flights were a cheap parlor trick with no commercial value. This reveals a hardwired glitch in how we process information. Destruction is driven by single points of failure that happen in seconds. Progress is driven by the quiet, agonizingly slow math of compounding. A plane crash is instant breaking news. 50 years of steadily declining heart disease rates is a silent statistic. This bias leads to a specific, fatal flaw in almost every pessimistic forecast. They take current negative trends and project them out in a straight line, ignoring the human capacity to adapt. In 2008, a prominent environmentalist looked at skyrocketing Chinese demand and calculated that the world was going to completely run out of oil reserves. Looking at the raw data in a vacuum, the math checked out. But markets do not operate in a vacuum. A barrel of oil went from $20 to $138. That immense price spike incentivized a massive wave of new horizontal drilling and fracking technology. Within a few years, global oil production didn't vanish. It surged 20% above previous high marks. When the stakes are incredibly high, but our personal control over the outcome is extremely low, we become highly susceptible to what we can call appealing fictions. If a financial manager promises a guaranteed, unwavering return regardless of market conditions, intelligent people will hand over billions of dollars without checking the underlying math. Our primal fear of ruin creates a vacuum. We possess a desperate need to feel secure, and we will eagerly embrace any story that satisfies that need, even if the data proves it is completely fabricated. To see how powerful these stories are, imagine an alien observer hovering over Times Square on New Year's Eve in 2007, tasked with monitoring our entire global economy. If that same alien returns exactly 2 years later, at the end of 2009, they see the exact same physical reality. The skyscrapers are still standing, the factories are fully equipped, the highways are intact, and the working population possesses the exact same knowledge and skills. But when the alien checks the data, they are completely bewildered. 10 million more Americans are suddenly out of work. Household wealth has evaporated by $16 trillion. Our capacity to build, invent, and produce had not diminished by a single ounce. The physical world was intact. The only thing that broke was a story. In 2007, we shared a collective belief that housing prices would always rise and that financial markets had perfectly priced their risk. When that shared fiction cracked, homeowners began to default. Those defaults cascaded into massive bank losses. The banks stopped lending. Businesses, suddenly cut off from credit, resorted to mass layoffs. Those unemployed workers stopped spending, triggering even more layoffs. This was entirely self-inflicted. It proves that raw manufacturing output is secondary. The narratives we tell ourselves about the future are the heavy machinery of the global economy. We cling to these narratives because we confuse fields of uncertainty with fields of extreme precision. In 2006, NASA launched the New Horizons spacecraft on a 3 billion-mile journey through the solar system. After 9.5 years of travel, it arrived at Pluto exactly 1 minute earlier than the engineers had projected on launch day. Their exact forecast was 99.99998% accurate. Astrophysics is a field of pure precision. It relies on the absolute laws of gravity and momentum. Finance, on the other hand, is driven by fear, greed, and unpredictable human reactions. But the idea of a NASA engineer having total, absolute mastery over a 3 billion-mile trip is deeply comforting. We want that same level of absolute certainty applied to our retirement accounts and market projections. We hire experts to provide the illusion of control. But building a financial plan based on the illusion of perfect predictability guarantees you will be crushed by the inevitable chaos of reality. If the world is governed by stories and our instinct for panic, our best defense is a personal strategy that accounts for human fallibility. The author's own family operates on a simple principle: independence is the ultimate financial goal. They ignore the pursuit of maximum returns in favor of a life lived below their means. While his income rose steadily over a decade in finance, his household lifestyle stayed completely frozen in his 20s. He didn't trade for a bigger house or a faster car. Every dollar from every raise accrued to an independence fund. By choosing not to match his spending to his earnings, he built a widening gap, not of possessions, but of options. This pie chart shows the resulting strategy. He holds nearly 20% of his net worth in pure cash, a move most advisors would call a mathematical mistake. That cash buffer ensures he never has to sell his index funds during a market crash. It is a price he willingly pays to remove the risk of being forced into a bad decision during a world crisis. This same focus on independence led him to pay off his home mortgage entirely, even though interest rates were at record lows. Cold mathematical logic suggests he should have leveraged that cheap debt to buy more stocks, but the feeling of absolute ownership over his shelter provided a sense of security that was more valuable to his family than the spread on a mortgage. We can easily see the cars people drive and the watches they wear, but we cannot see their wealth. Real wealth is the hidden gap between what a person earns and what they actually spend. This discipline is what allowed his father to quit his job as an ER doctor the moment he'd had enough. Because he'd spent decades living below his means, he possessed the wealth of a suppressed purchase. The highest dividend money pays is the power to ignore the alarm clock and work on your own terms. That ability to do what you want, when you want, is the only return that compounds. Every investor has different goals and a different capacity for risk. Success is simply finding the specific strategy that allows you to remain in the game and sleep soundly through the night.